All right. Hey, everyone. And thank you so much for tuning in to another episode of the Sage Investor webinar. I am your host, Jin Wang. This webinar is brought to you by the Sage Investing Group, which is founded by three former Big Four auditors turned full-time multifamily syndicators. So our mission is to empower other risk-averse investors like ourselves to diversify their portfolio with cash flowing and appreciating assets such as apartments. So if you're interested in learning more or interested in working with us, we encourage you to set up a discovery call on our website at sageinvestinggroup.com. So today's objective for the webinar is to really help our audience, which consists of both investors and syndicators, learn how to mitigate risks in their investments from an asset manager's point of view.
Good afternoon, everybody.
Oh, yes, I'll introduce you, Dave.
Okay.
Sorry. So the agenda for today will be as follows. I'm going to make the guest introduction. Dave is eager to be introduced, so we'll introduce him shortly. And then I'm going to conduct the interview on the topic of asset management. And then we'll open up the floor for a Q&A at the end. You guys are welcome to type your questions in the chat box or to unmute yourself to ask. And the webinar should be wrapped up in 1 hour or less. And now let's get started. So I'm excited to have Dave Sherbal. He's a partner at C2G Asset Management, join us as our special guest today. Dave actually shares a very similar background with the Sage ladies, and that is we're all proud auditors / CPAs. Dave is actually one of two partners at C2G, and it stands for Cradle to Grave. It is a third-party asset management company that operators can engage from the inception of a project to the exit. And with over 30 years of real estate investing experience, Dave currently oversees over 5,000 multifamily units and over 600,000 square feet of office and retail space. So welcome, Dave, and thank you so much for joining us today. Please take a moment and tell us a little bit more about yourself. Maybe how you can tell us about how you started from being an auditor to an asset manager today.
Well, thank you for having me. Appreciate being on. I started in real estate in the late 80s. I was in public accounting. I was an auditor. Interest rates, 13, 14, 15%, lots of bank foreclosures. The accounting firm I was working with did a joint venture with a gentleman who was a workout consultant, and no one in the public accounting firm really understood what he was doing and how it would help them grow to be a partner. I joined his group, and we took over a public company, delisted it, and over 5 years we worked out their various real estate. And I liked it. I understood it. My auditing background gave me the ability to, dig in deep and find where there was waste and inefficiency. And I really didn't like public accounting, so I stayed in real estate and just been doing that, over the last 30 plus years, mostly on the ownership side.
Awesome. Yeah, we are very similar. We didn't really like public accounting either. So we've switched over to the other side. So real estate investing is a little bit more exciting for us as well. So let's maybe, we start off with no investors left behind. So maybe you can start off with the basics and kind of tell us what are the roles of the asset manager?
So every company, every firm has a different take on what an asset manager is. I've always done well, more of a hands-on asset manager. If you're working for big institutions, their asset managers come out once, twice a year. They're at the macro level, 30,000 feet type of a vision. Being a workout guy and being an owner, I've always been hands-on, where I'm really focusing on the day-to-day operations, pushing the management company, laying out the game plan, kind of walking them through it, and then making sure they stay within the white lines. I know on some of the syndicators, the asset manager is more, what I call administrative asset management. the tax returns, the partnership, more of the bigger picture, the equity raise, the investor relations. But on my assignments, for the most part, I'm more on the micro level. Usually, I get hired on problem properties, and I kind of come in, triage, see what the problems are, kind of lay out a game plan, and then work that game plan.
Okay. So typically though, you guys prefer coming in maybe at the start of the project or even before the project kind of kicks off to help, I guess, put together maybe CapEx budgets and things like that, or?
So when we started C2G, we were getting
Mhm.
brought in after the deals were kind of in trouble.
Mhm.
And we just said to our clients, look, why don't you bring us in when you first are looking at the deal? We'll help you so that, you don't have to hire us when there is trouble.
Mhm.
Uh, maybe we can see some stuff that, we've, hit the landmine on earlier,
Mhm.
and, you can, avoid the trouble.
Right.
30 plus years experience just means I've walked in every landmine once or twice.
Right. So we know how to avoid those. Um, Perfect. So then what should investors look for in a quality asset manager? I'm assuming you're a quality asset manager, having been in the business for such a long time. So what are some good qualities that you have that, other investors should look for when they assess a project to invest in?
Um, you know, for me, if I was hiring, an asset manager to join my group, I'd find someone with a similar background. I always like the public accounting auditing background, because it's detail oriented, and how to. A lot of investors just read the financials, but they don't know how the numbers get into the financials. So
Mhm.
C2G, we're looking at source documents, the actual invoices, the detailed GL, seeing how management companies are creatively keeping the books and where the bills are, and if the vendors are overpaying. We like someone that knows the macro level, just how to increasing value, through the operations, or how to help out on the balance sheet and managing that. So we're trying to find someone that knows more on the ownership side than on the property management side. The property management side is the easy part of the equation.
Right. Yeah, there's a lot of moving parts, as an asset manager that you have to know and be in control of, I suppose. And like you mentioned, I think knowing how to read the financials is critical. Um, because as we are preparing K1s for our investors, nowadays, it brings to light how critical it is to kind of maintain clean books throughout the year so that you have good information to provide the CPA with to work on the financials um, for the investors in a timely manner. So,
Definitely.
yeah.
And so, you got to kind of find somebody, reference checks, look, everyone, can be an asset manager, but, if your deal is, you want them to be hands-on, you got to kind of look at that. What we provide our clients is more of a plug and play option. A lot of syndicators, a lot of our clients are deal folk, and they need to spend their time finding deals, raising the equity. If they get bogged down in doing the asset management, then they're not, generating, new deals. So we have the plug and play option. We come in at any point of the process, whether it's from due diligence to an operations or a disposition or a refinance.
Okay. So then, based on the experience that you have, can you tell us, like, to help our investors out when they're vetting deals themselves to decide to invest in a deal or not? Like, based on your experience, what are some red flags that investors should look out for when they are reviewing opportunities to invest in?
So, what I kind of look at is,
Mhm.
or go by is, one, the broker's OM. It's really just a lie. It's a hook to get, people excited about the deal. And while the brokers, they do a lot of this, they lay out a story. Okay, we rehab 15 units and we got the premium. You can do it on the rest. So I just look at the broker's book as a starting point, and I don't, make my investment decision 100% on what they're saying, because they spit out the same stories on almost every deal. Number two is I never trust the financials from a seller because, they're making them so that the story, gets explained, and they're putting things either on the balance sheet or below the line. So I try to dig down and make sure that I get a full due diligence of 30 days, so that we could really see what are the CapEx needs, what are the working capital needs, what's everyone hiding that is not coming out in the package. The package always looks good.
Right.
It's really your ability to have the right team with you, have some good, contractors or construction managers, which we have, that we can go make sure that we're adjusting the risk. We're scoping all the lines, we're walking all the roofs. We are making sure that if there's any risk out there, we're quantifying it, and we're making sure that it may not affect the future viability of the property. So, due diligence is everything. Don't skip on time. Don't skip on spending some money. If you can get the deal, uh, make sure you're buying right, because if you buy wrong, it's tough to rebound from that.
Right. Okay. So it sounds like what investors should look out for is just to check that the operator has done their job and do a thorough due diligence on the property before purchasing.
Right.
Okay.
And if you're investing in the syndicator, look, you got to do due diligence on the syndicator.
Mm-hmm.
Not one deal, but look at all their deals. Look at their track record. If you're in a market where they're buying or they have a deal, go see their deal. Go see how they operate the property. We do that with management companies. You should do it with the sponsor.
That's great advice. And so then based on your your experience, what have you seen to be the cause for projects to become problematic after the acquisition?
Inattention. Management companies not being attentive to the deal. You may just be a small client, or they
Mm-hmm.
have lots of bigger clients. Your deal may be a one-off in a market that they're not in that market, and the regional is flying in or driving in.
Mm-hmm.
Uh, their regional staffs may be overworked, where they have too many assets and they can't get to yours. That's a problem. Owner not being attentive to their own deal. If you don't go visit your deals, you're setting out a message that you may not really care about it. So the staff then really doesn't care about it, and they kind of don't pay attention to the deal. You have to go out. Reports only tell you 75% of what's going on. The other 25%, it's being on your deal, being on your competitors' deals, and kind of knowing what's going on in the market.
Very good. I absolutely agree with that. You have to manage the property manager at the end of the day and make sure that they are doing their job and running your property optimally. And you won't really know that unless, you obviously are hands-on and you visit the properties um, and you ask questions.
Yeah, they're getting their
Yeah.
fee off of the revenue. They don't care
Mhm.
what goes out the back door. So, you have to manage them, and you have to motivate them where if you're making money, they're making money.
Right.
Can't be a win-loss situation.
Right. All right. Okay. So let's say that you are managing a property right now. And what are some tips and tricks that you have for getting an asset to perform? Like, what do you typically do when you start? I guess when you start on a project, you get invited to help out on an asset. What are some, and it's problematic, right? So, what are some things you guys typically do to kind of help fix those problems and bring the project back in line?
So, if it's a cash flow issue where they're not performing, I usually go down the balance sheet, see if all the reserves have been tapped, if they've been done timely. I look at the payables, kind of say with management, who are the one-off vendors that you're not using again, and maybe negotiate some discounted settlements. So I try to, work the assets on the balance sheet that I can generate cash. On the expense side, I'm looking at expenses, looking at how much they're paying for stuff. So I'm looking at invoices, Are we paying too much for turns? Are we paying too much for the carpet? How much carpet are we doing? Are there other ways of being more efficient? Do we have, too many housekeepers when we can probably cheaper to third party it out? I'm looking for how long vacants are sitting around. Are we doing everything in house to save money, but it's causing vacancy loss? I look at the rent roll. I saw it, see what the lease expiration is. Are we managing it properly? Or all the leases ending at the end of the month? Because if they all end at the end of the month, you can't turn them quick enough. So you're causing a vacancy. So my properties, we make sure the leases are expiring all through the month. So it makes the staff more efficient than having to get all the units on the last day. We're looking to make sure everyone who's month to month is paying the month to month. We're making sure the manager is charging late fees and admin fees and not writing them off. So, that's a lot of stuff by just looking at the data and just trying to figure out where you are. So, balance sheet to help get cash. I look at the revenue. Do we have a lot of bad debt? Okay, what's our leasing criteria? Who are we letting in? Who's overriding the system? Are they actually reviewing the source documents they're supposed to be getting during the application process? So, when things happen at a property, there's a lot of symptoms. The key then is once you get the symptoms is to find what the root cause is and cure the cause, not cure the symptom.
Okay. Yeah, that's got to get to the root of the problem in order to fix it. You can't really just focus on, what is going wrong, but how to get to the root of that so you can, yeah, find
If
a
you go,
cure.
if you go look at it, you'll see, if you're not leasing, is it a product issue? The product
Mm-hmm.
is dirty. Is it a price issue? It's too expensive. Is it a people issue? The leasing staff are not trained well on how to close. Is it a promotion issue? You don't have enough traffic
Mm-hmm.
to cover your needs. Is the back door open? We're not renewing enough people because we're not giving quality service. So, there's just a lot of stuff, which we call property management 101, that everyone just kind of seems to forget.
Right. And I guess, so what if you find that, it's the property manager that's the issue? Like, what do you guys typically help clients do in that situation?
So, if we find out it's a staffing issue, we'll make recommendations to the management company that they need to replace.
Mm-hmm.
If it's a management company issue and inattentiveness, we will, discuss with our clients, is there a global relationship here? Is this a one-off where, we think that we can switch out and get some attentiveness from the new management company? So I'd say most of the time when there's problems, ownership would like to switch. It's an
Mm-hmm.
easy reaction. It's cutting it out and starting fresh. But every time you switch, your properties will have a decline for 60 to 120 days because whatever problems that you have are going to come to the forefront. It's going to rise up. You're going to find out all the things that the previous regime wasn't doing,
Mm-hmm.
and it takes the new firm time to staff up and to get their sea legs wet.
All right. So when switching to PM, just be prepared for things to get worse before they would get better.
Always does.
Yeah. Okay. All right. Well, so when you come into a project, how long does it usually take for you guys to kind of pick up, what's happening, what's going on, to kind of assess the issues and to get yourself kind of in the know of what is going on? Like, how long does it take for you, that learning curve, when you jump on new projects?
So, look, we typically reading the financials, going through the rent roll, looking at bills and stuff, that doesn't take that long. Getting out to the property, that helps a lot. It's really sitting with the owner
Mm-hmm.
and asking what their overall game plan is. What's the goal? A lot of times people buy deals and, yeah, we want to sell it in X, but they don't lay out, the full detail of the game plan. They leave it up for the management company. So typically when I come into a deal, it's like, okay, are we in sell mode? Are we in refinance mode? Because that's a different way to operate. Are we hemorrhaging cash? Okay, well, we'll manage the cash and it's a different way of operating the property. But typically we'll know within 30 days kind of what's wrong, if not
Mm-hmm.
sooner.
Mm-hmm.
If it's a problem property, the financials will tell you pretty quickly.
Okay. Okay. So I guess in today's environment, what are some challenges that asset managers are facing in the multifamily industry, and that investors should be aware of to kind of look out for when they're assessing new investments today? Like, what are some things that are more prevalent today than maybe it was in the past that people should be more cognizant of?
Uh, Finding a good management company,
Hmm.
uh, buying deals, your construction budgets, costs have gone up. So stuff that you might have thought was X dollars is probably going to be more. There's a lot more rehab deals chasing contractors. So you really have to find good contractors with good price points, that have enough bench strength. So they're not, just having a team of two. You want someone a little bit bigger. It may cost you more, but you get certainty of getting the work done on a timely basis. Because if you're rehabbing, it's all about timing, getting the new people in and the old people out. If it's a small vendor who may have better prices,
Hmm.
they may not have the bench to get it done. And so, a 60-day project may take you 90, 120 days. Having good, construction contracts really helps out. Everyone's a rehabber now because, that's what's out there, but not everyone is really good at doing it. So, you have to make sure that your management company is good at it. You have to make sure you're controlling that process.
Okay. That's very, very true. Yeah, I mean, everything, all the cost is going up. So it's just making sure that the project is budgeted sufficiently for it and making sure that, it's kind of performing, with the right timeline, with sufficient timeline, given that there are delays in renovation these days with labor shortage and, even material shortage. So, yeah.
Yes. And, look, it's better to, have your numbers right and
Hmm.
have the money sitting in the bank somewhere than having to do a capital call to find out you're missing. So the
Right.
more you can do on the front end, the better it is. You'll always run into something that you never thought would happen, but it does.
Hmm.
Uh, but it makes it harder if you don't have working capital or you're trying to. The banks are getting harder getting the draw money out, the interest reserve draw money out. So don't rely on just rolling your escrows, your replacement reserves, your capital repairs, and getting the interest reserve back to be your source of working capital. Lenders are, especially the lower down the food chain, lenders, they're getting very tough and they're switching in midstream how they fund money back. Have
Hmm.
enough working capital so that is
Hmm.
just gravy.
Right. Yeah. I mean, there's nothing that you can do on the lender side to force them to send you money quicker. So it's just
No.
kind of preparing yourself with enough contingencies and other reserves on hand to get you through the renovations. Yeah.
And find a contractor that has a line of credit, someone that can, that's big
Okay.
enough that they can handle getting paid every 90 days if that's how the money
Hmm.
gets. But, um, you know, again, don't rely on using those escrows as quickly as possible. Have
Right.
extra cash up front.
Okay. That's great tips. That kind of goes into my next question, which is what advice would you give to operators? And it seems like just make sure you have enough cash. What else would you what other advice do you have that we can use?
Make sure you find a management company and a team
Hmm. Hmm.
that are vested in you as a client, just not the management fee, but people that have done the type of work you're doing, that when times get tough, they're in your corner, because when times are good, everyone's in your corner. I would always be bidding stuff out. I would always be looking to learn new tricks, and find, ways to save money or make money. Um, you know, Sometimes you have to spend to make money. Sometimes you have to try, a rehab. And if it may not work, the unit type, you switch. Nothing is set in stone like on the budget. You got to be very adaptable in today's market.
Right. All right. Well, thank you so much, Dave. That's all the questions I have for you, but I know that our audience probably has some other questions as well. So I'm going to open up the floor to receive anybody's questions that you guys may have for Dave. I would definitely take advantage of this because Dave is just super straightforward and super honest, very transparent. So a great person to pick his brain. So Maggie, did you have a question?
Yes, I have a question, Dave. You mentioned earlier when you are a refi mode versus a sale mode, there's different ways that you will approach it. Can you share what you will change operationally in the refi mode versus a sale mode situation?
You know, if I'm selling it, there are certain things on the CapEx I would stop, just because I'm selling it and someone else is, can fix it. Different ways. They're both going to be similar on concessions, but I may use different type of concessions, for a sale so that I don't get dinged for it. So for the sale, I'm trying to get it to a certain occupancy level, but pushing the rents because at a certain point, I'm not going to get credit, for being 99%. Whoever's underwriting the deal plus the lender when they underwrite it, they're going to be giving you, 94%. So some things that I might do on a sale, I wouldn't do on the refi because I still own it after the refi. So, it just kind of depending on the situation.
Hey,
Tom?
Dave, this is Tom. Maybe an easy question for you, but just curious on your views. If you got a property manager you've been working with and you've been purchasing C-class properties and you're starting to move into the Bs and maybe A-minuses, do you grow with that same property manager or do you think you should go find another property manager and grow with them?
It depends on their experience level. I mean, look, managing an A, managing a C, there's different factors to it. They're both challenging, but management doesn't get easier because you have a nicer property. You have different issues that you have to deal with, different type of customer service. It's really about who the people that they have. But, to me, I always talk, my clients say, let's get a management company. We'll go meet 4 or 5. You never know which ideas. But we also, when we get down to the final 1 or 2, we're shopping their properties. If they're not clean, if the staff's not attentive, then we know they're not going to be attentive on our deals. And when we find the regional they want to give us, we shop their deals to make sure that they're attentive and not. So it's all about experience on your type of product and experience in that sub-market. But it doesn't mean that if you run C's, you can't run an A- or a B. Now, if you run an affordable housing deal versus a market rate, there's differences. New affordable housing fills up very quickly and there's not as much sales to it. Where on a market rate, there's more to do. But I would always be trying to, find new ideas and kind of see what's out there. You may be surprised. You may hear things that marketing is different on a C than an A. Amenities are going to be different. Customer service and interaction with customers are going to be different. So, you just have to see if the people that you're growing with are able to adapt to a different type of product.
Yeah, I agree. It kind of depends. It depends on the people you're working with. Thanks, Dave. Appreciate it.
No, not a problem.
Thanks, Tom. We have a question from Bao in the chat box. He asks, what are your recommendations on how much money we should set aside for operating reserve?
I would, for operating reserves, I would have at least a month's worth of expenses plus the mortgage.
Just 1 month of operating expenses?
Plus the mortgage. That's good. I mean, if you collect no income, you can cover, and you're always going to collect income. It depends on if you're rehabbing the property or not. Also, if you're dropping occupancy, then you may need more than that because in my gut is the lender will be having money sitting in an interest reserve if you're dropping occupancy,
Right.
to get to more units and be more efficient.
Right. Okay. All right. Does anybody else have any other questions for Dave while we have him here? I think you
How do we
did
get a
improve.
hold of you, Dave, if we have a question later on?
So my email is dave@c2gam.com.
Excellent, thank you.
And my cell number is 954-646-7382. And you guys can call me or my partner anytime. You know, we don't charge for phone calls. You know, we introduce people. You know, if we know the answer, we'll, you know, give you our opinion. And if it's something we don't know, we'll point you in the right direction just because we know enough people to point in the right direction.
Yep. And I can vouch for that. You are a great connector. You seem to know a lot of people in this industry. And so, great source of information. Always very open to talking to us and just sharing information and your knowledge with us whenever we call you and have questions. So, definitely a great person to know.
Dave, I have one last
Thank you.
question. What do you personally, as a manager, invest in?
So I have investments in multifamily. I have some investments in office. You know, so on the multifamily, just over the years, you know, I've picked up some shares. But you know, I was involved in the deal, so I know what I was getting myself into. I knew who the sponsor was. I knew who the management company was because I picked those management companies. Every once in a while, clients will say, "Hey, if you can do something on your price points, and take a piece of the deal, so that I stay with the deal for a while." But so I'm in Plano, Texas. I'm in LA. I'm in St. Petersburg, Florida. I'm in Miami. So just deals I've worked on over the years.
Awesome. Thank you. All right. Well, if we don't have any more questions, yes, I will share Dave's information, contact information in the replay email. So you guys can feel free to reach out to him. But thank you so much. Thank you so much, Dave, for your time. Really appreciate all of your valuable insight that you shared with us today. And thank you, everybody, for attending.
My pleasure to be here, and love working with the ladies from Sage.
Thank you. We'll talk to you soon.
Be well,
Bye,
everybody.
everyone. Thank you. Have a great day.